Infrastructure isn't about size, and it's not about popular things. It's about function. Money stops funding ideas. It starts funding what has to work. Capital has a price again. Time matters again. And that means money is no longer willing to pay for future results. Liquid markets lose depth faster than private ones. Hi, my name is Ivan Marchena, Chief Communication Officer at A-Lens. And today we will speak about investing in 2026. What gets funded, what gets ignored. When we talk about investing in 2026, we are not really talking about markets, we are not talking about assets, and we are definitely not just talking about returns. What we are really talking about is change in how money thinks. A change in how capital decides where it belongs. The money didn't disappear, it didn't leave the market, it just stopped being patient. We are now living in the world where mistakes are expensive and uncertainty isn't a temporary phase anymore. It's the background. And in a world like that, money stops funding ideas. It starts funding what has to work. So if you want to understand where money will be in 2026, you can look at the market like a trader, and you can look at it like an optimist either. You have to look at it like a system, asking one simple question. What still works when everything else is falling apart? Why money in 2026 no longer pays for the future? For decades, the financial system ran on advance. If you could convincingly explain what the world might look like in 5 or 10 years, capital will show up early. That worked not because the ideas were brilliant, but because time and risk were cheap. Near zero interest rates meant one simple thing. Being wrong didn't cost much. If a business model failed, you refinance. If a prediction missed, the market gave you another shot. If there was no income, rising valuation filled the gap. By 2026, that logic is broken. Capital has a price again. Time matters again. And that means money is no longer willing to pay for future results. Now an asset has to explain what's happening right now, where the income comes from, who's paying it, and what happens if growth stops. Why must smart investments stop making money? One of the most uncomfortable truths of 2026 is this. The market no longer rewards intelligence, it rewards structures that work. An investment can be technologically impressive, strategically sound, ideologically appealing, but if its economics need to constantly attract new money instead of generating cash, it doesn't create wealth, it just moves it around. That's why so many smart investments don't fail in a crash, they just fade out. Liquidity dries up. Attention moves on. Valuations stop going anywhere. And for a private investor, this is especially dangerous because getting out is hard and staying in makes no sense. Where capital has been making money in recent years, if you put emotions away and just look at the data McKinsey, Bain, Preqin, Vice, a clear pattern shows up. Capital has been consistently making money where income is contractual, not market-driven. Place where there's a fixed term, a clear obligation, and a known source of payment. Private credit, asset-backed financing, infrastructure projects. These auctions kept delivering stable returns, even during high volatility and tighter financial conditions. And this isn't a defensive move, it's capital adapting to a world where the future is no longer discounted for free. Why 2026 will bring more stories and less money? The paradox of the current cycle is the following. As capital leaves hype-driving sectors, the news gets louder. The reason is simple. Attention is still cheaper than money. The market fills up with complex narrative, futuristic concepts, elegant theories. But the automatic link between a good story and real income is gone. A story can be logical, ambitious, inspiring. But if it's not built into a system of required payments, it stays a story, not an asset. In 2026, the market stops confusing popularity with value. And this is exactly where most investors will get it wrong again. System bottlenecks. Where money goes out of necessity, capital is no longer clustering around trends, it's clustering around bottlenecks. A system bottleneck is a place where cutting funding doesn't just reduce profits, it breaks the entire chain of supply, production, logistics, energy. In these areas, money shows up not because investors want to invest, but because there is no alternative. This is a key mental shift. The most durable returns come from places where investment isn't a choice but a requirement. Why infrastructure is the core of investment logic again? Infrastructure isn't about size, and it's not about popular things. It's about function. By 2026, infrastructure assets become especially valuable because they don't rely on wars, don't need constant growth, and don't live on expectations. Their income comes from usage. As long as the system is running, the assets pays. That's why large capital is willing to accept moderate nominal returns in exchange for stability. This isn't caution, it's a mathematically sound decision in a world of high uncertainty. Why liquidity is no longer an advantage? Liquidity used to be seen as protection. Today, it's become an amplifier of instability. Algorithmic trading, ETFs, and derivatives has turned liquid markets into resonance systems. Data from the BIS and the ECB shows that in stressful moments, liquid markets lose depth faster than private ones. To put it simple, if you can exit instantly, then everyone can. That's why capital increasingly prefers limited liquidity if it comes with predictability, a contract, and a clear control exit path. Why locked money generates more? In 2026, illiquidity stopped being a flaw. It became a quality filter. When capital can be pulled out instantly, it stopped reacting to noise. That changed the behavior of both the investor and the assets. In liquid markets, prices are set in real time by news, algorithms, and emotional reactions. Every shock is amplified by speed. In illiquid structures, pricing is driven by the economics of the deal, cash flow, obligation, and contract performance. That's why private markets have constantly delivered high risk-adjusted returns than public ones in recent years, confirmed by data from Preqin, Cambridge Associates, and the BIS. This isn't about locked money, magically earning more. It's about earning in a cleaner way. Returns come from the asset doing its job, not from price swings, and when instant panic is removed, most meaningless losses disappear with it. Why public markets no longer reflect the real economy? By 2026, public markets have completely stopped being a mirror of the real economy. Assets prices now reflect cash flow less and less, while expectations, monetary policy, and derivatives structures more and more. ETF, auction, futures, and algorithmic trading have created a layer on top of the economy, one that follows its own rules. As a result, market can rise while the economy slows and fall while company revenues grow. This isn't an anomaly, this is the new normal. According to data from the BIS and the ECB, during periods of stress, liquid markets lose depth faster than private ones. In other words, the places where you can exit easily are exactly where everyone exits at once. That makes public markets great for speculation, but weak tools for long-term capital building. Private markets as an alternative financial system. The growth of private credit isn't a trend or a fashion. It's a structural response to tighter banking regulation. After Basel III and the reforms that followed, banks simply can't lend at the same scale as before, especially to small and mid-sized businesses. But businesses always need money for working capital, for equipment, for contracts, for growth. Private capital steps in to fill that gap. This is how a parallel financial system forms. One that's faster, stricter, and simpler. There is a project, there is due diligence. There is a contract, and there is a payment. Estimates from McKinsey and the IMF show that private credit's share of global lending keeps growing for one simple reason. It solves a real problem instead of creating a new one. This isn't an alternative to banks, it's their functional extension where banks no longer operate. The return of the real economy. The real economy is becoming an investment chain again, not because it's authentic or easy to understand, but because in a world of high uncertainty, it provides an anchor: physical assets, infrastructure, manufacturing, logistics, agriculture. All of these sectors share one thing: mandatory payments. Goods have to be transported. Energy has to be produced. Equipment has to be serviced. Where there is a physical asset and a contract, capital feels support. Not a guarantee of growth, but a guarantee that the system keeps working. And that's where money returns, because the alternative is relying on expectation and sentiment. Why growth is no longer the same as wealth? One of the biggest mental mistakes of the last cycle was treating growth as wealth. Rising valuation without cash flow create the illusion of success, but not financial stability. By 2026, the market no longer guarantees that growth will keep getting funded. If an asset doesn't generate cash, it becomes hostage to next capital round, the next cycle, the next move shift. Wealth isn't built through expansion, it's built through the ability to hold and control cash flows, not by getting bigger, but by paying consistently. Where the private investor fits. In 2026, the difference between a private investor and a fund is no longer the size of capital. It's the approach. Funds have been working with structure, contracts, and cash flows for a long time. Private investors traditionally worked with expectations and price. That gap is now closing. Access to tools has changed. Today, a private investor can use the same logic as institutions, understanding where income comes from, evaluating obligation, diversifying by cash flows. The only real requirement is this: stop playing the game of trading and start working with what actually pays off. Why smart people might get it wrong? The most painful mistakes of 2026 won't be emotional. They will be intellectual. People will defend beautiful ideas because they have invested ego, time, and reputation into them. And the smarter the idea, the harder it is to walk away. But the market doesn't pay for intelligence. It pays for structure, discipline, and cash flow. That's why many very smart investors will get stuck in ideas that are logical, elegant, and economically useless. The market doesn't reward ego, it rewards results. If we boil it down, in 2026, money won't be where things are louder, faster, or more popular. It will be where there is necessity, structure, and obligation to pay. The market will still be full of ideas, forecasts, and beautiful stories about the future, but capital will move toward places where the future is already built into today's economics. If this way of thinking resonates with you, write in the comments which assets you see as real, which ones you see as just stories, and where you think money will actually be in the next few years. And if you want more breakdown like this, subscribe to the channel and hit like so YouTube knows this kind of content everyone needs. See you in the next video.